The volatility trap, why stability in charts is a setup for chaos. They say the market rewards patience, but what if I told you that patience itself has been turned into a trap? That calm, steady chart you see, those flat candles, quiet volumes, balanced moves, are not peace. They're bait. They are the silence before a man-made storm, a digital calm programmed to seduce you into believing that nothing is happening. But something always is. Beneath that apparent stillness, someone is setting the table for chaos, an algorithmic ambush that feeds on the illusion of safety. It starts with a feeling, that warm sense of comfort you get when the market moves in narrow ranges. Your mind begins to relax. You tell yourself, finally, some predictability. Maybe you sell options to collect premium. Maybe you tighten your stop loss because volatility is dead. That's exactly what they want, because every time you start believing that the storm has passed, they trigger it. Traders call it the volatility burst, but on the broker side, it's called rebalancing events. Exchanges, liquidity providers, and high-frequency funds measure the density of orders and the clustering of stop losses around stable zones. Think of it like sonar. They ping the market for where your comfort lives. The flatter the chart, the clearer your position becomes. The moment they know where your belief lies, they plan the strike. That's why those perfectly stable days often precede destruction. You see the chart compress, volatility drop, and indicators align beautifully. RSI flat, Bollinger Bands narrow, volume declining. You think, this will break out soon. I just need to pick the right direction. But you never do, because they don't break it for you. They break it against you. The trick is psychological. Humans crave patterns. We find peace in repetition. The market knows that. Algorithms map your behavior. How many times you buy dips after 3 green candles, how often you sell after a sudden red spike, how long you wait before adding margin in quiet markets. All that data, every click, every hesitation, it's behavioral currency. You're not being watched by one entity. You're being modeled by hundreds of them simultaneously. Let's take a real-world scenario. It's midweek, no news, no earnings, no data releases. Nifty, S&P, NASDAQ, all flat. Retail traders start selling volatility through options because it's free money. They see low IV and assume the calm will last. But institutional traders, they're not trading the calm. They're trading your belief in it. So, as you sell those options, their algorithms quietly accumulate positions designed to explode the moment your complacency peaks. And when the trigger comes, maybe a small rumor, a sudden futures imbalance, or even a deliberately timed headline, volatility surges 5x. You panic. Your stop loss hits. The broker's risk engine forces liquidation, and suddenly what was a safe week becomes a bloodbath. You're not reacting to market randomness. You're reacting exactly as predicted, because your past reactions have been cataloged. Think of volatility like oxygen. Too little, and the market suffocates. Too much, and it burns everything. So who decides how much oxygen to pump in? The same entities that profit from the imbalance. Liquidity makers, hedge algorithms, and brokerage risk managers. They artificially suppress volatility when they want to lull you into selling premium or entering narrow trades. Then they unleash it when they need liquidity, wiping out those positioned on stability. It's not a coincidence that retail traders lose the most money after long periods of calm. Look back at history. August 2015's flash crash, February 2018's Volmageddon, March 2020's sudden crash after weeks of consolidation. Every major market event followed a deceptive calm, low realized volatility, rising optimism, and over-leveraged positions. It's a pattern older than algorithms, but now supercharged by them. So how exactly do they know when to strike? The answer lies in correlated behavior analytics. Brokers aggregate your order history, dwell time, and interaction patterns. When most accounts show identical tendencies, like holding longs through low volatility, the algorithm interprets that as herd consensus. That's the signal. Once the herd forms, a single volatility injection can harvest the entire cluster. They call it liquidity creation. You call it chaos. Let's visualize this. Imagine you're a shark hunter. You throw chum into the water to attract your target. But in markets, you're the chum. The calm is the ocean surface, peaceful, glassy, silent, until something massive moves beneath. The system waits until the perfect number of traders lean too far on one side. Then it flips. The chart doesn't react. It executes a plan. It's easy to dismiss this as paranoia, but let's look at facts. Exchanges literally profit from volatility. More trades, more fees. Market makers profit from wider spreads. Hedge funds profit from volatility arbitrage. Even brokers benefit indirectly when traders churn. So, why would the system want long, boring stability? It doesn't. It just needs to fake it long enough to make you comfortable. And here's the disturbing part. Your trading app is the perfect psychological mirror. The color scheme, notification tone, order placement delay, all subtle tools to shape your emotion. Ever notice how your heart rate spikes when you see a red candle after an hour of flat lines? That's not just instinct. It's conditioned response training. Over time, your brain starts linking boredom with risk reduction and sudden movement with danger. The market uses that reflex against you. Now let's make this personal. Picture Michael, a disciplined trader in Chicago. He's been trading index options for months, building slow, steady returns. Every morning, the chart opens flat, volatility bleeds lower, premiums look safe. He sells strangles, collects theta, feels in control. But what he doesn't realize is that his account, his activity, is part of a larger data set, one where thousands of traders like him are positioned identically. One Friday afternoon, 1:42 p.m., the market spikes 0.8% without warning. His short call side starts bleeding. He adjusts. By 1:55 p.m., it drops 1.2% the other way. Now both sides are red. His broker's dashboard flashes warnings. Margin required, volatility rising. He hesitates. He closes one side at a loss, doubles the other. 2:10 p.m., volatility doubles again. His account blows up. The same calm that seduced him set the stage for his destruction. But was it random? No, it was the engineered breaking point for thousands of Michaels. The volatility burst wasn't chaos, it was harvest. Now, before you think this means you can't trade, let's be clear. Awareness changes everything. The trap only works when you believe the calm means safety. So, next time the market looks perfectly stable, remember, equilibrium in markets isn't peace, it's compression. And compression always ends in expansion. Here's what you can do. Stop mistaking silence for stability. Watch how volatility decays, not just how prices move. Track open interest clusters. When the majority sells volatility, stay out. When everyone says nothing is happening, prepare. The best traders aren't predicting the storm, they're reading the quiet that precedes it. The next time your chart feels too calm, zoom out. The system is waiting for you to breathe out, and that's when it strikes. Don't give them your rhythm. Change it. Be unpredictable. Because the only way to survive a machine that trades your psychology is to stop behaving like the rest. And remember, the real trap isn't volatility itself. It's the belief that you can ever be safe in a system built to profit from your fear. If you learned something today, hit that subscribe button. Like the video, drop a comment with your thoughts, and check out the other deep dives waiting for you. Because what's coming next might just change the way you see every chart you've ever trusted.